The next slide we're going to look at is slide 5, which picks up the story that we started on the first two slides, looking at the movement of short-term interest rates versus long-term interest rates. And just to review, short-term rates are what are influencing what you pay when you borrow money to buy a car. The long-term interest rate is what is going to influencing the mortgage interest rate that you have to pay when you buy a house. And usually, as we saw in the first two slides, there's a differential, a fairly significant differential between the short-term interest rate and the long-term interest rate of about 2%, sometimes 3%. But what you see in this slide, slide 5, is the 90-day interest rate in the United States versus the 10-year rate. And what you see is that the long-term rate, the 10-year rate, is above the short-term rate by a little bit at the beginning of this period, but actually goes below the short-term rate in 1998, and then goes slightly above the short-term rate, and then is significantly below the short-term rate in the year 2000. Okay, so as we were entering the new millennium, strange things were happening in the money market versus the bond market. The bond market interest rate and the short-term rate came together, which for people who were refinancing their homes, as I said, I had to pay a lot of interest on the house I bought. I could refinance my mortgage at a lower interest rate. And especially in 1998, when interest rates came down to 4.5%, that allowed people to borrow money at 7.5%, in my case, instead of 13 or 14%. That was a big, big savings. And so for ordinary people, people struggling to make their monthly payments, this was a godsend. They liked that. They liked the fact that long-term rates were coming down, and they actually lower than short-term rates. But the banks did not like that, because the banks make profits on the differential between the short-term rate, what they have to pay out for the CDs that they issue, and what they are able to lend out long-term to corporations or to people in the mortgage market, etc. So that differential disappeared for not a short period of time, but for a long period of time. That the banking system in the United States was under pressure. If they wanted to be just plain vanilla banks, they were not going to do well in this environment. And so what they started to do is they began to take more risks. And they changed their whole mindset that would eventually become very, very problematic as we enter into the 2006, 2007, 2008 period. We're previewing things here. But basically, this is an important chart. It also shows that the Federal Reserve has a conundrum, which is how do they get that long-term rate to stay above the short-term rate? Well, the only way they can do that is by lowering the short-term rate, which they eventually do once the recession hits. But they were dealing with a booming economy in 1997, 98, 99, 2000. This was what people were worried about, was the Y2K problem. And they thought that the economy would hit a brick wall. But it didn't. The smart people, people that had corporations that had to deal with that problem with the 2 digits versus 4 digits for 1999 versus 2000, went out and bought new computers. They went out and massively replaced their computer stock. They also were investing heavily, $1 trillion, in cell phone technology. It was a business investment boom that pushed the American economy forward. And that's not when the Fed should lower interest rates, because that's inflationary. That how do they lower interest rates? They buy U.S. government treasury bills to pump money into the banking system, driving down short-term rates. That gives the banks more to lend, but then that can create inflationary pressures, which they're afraid of. And so the Federal Reserve was holding tight to short-term interest rates. And the long-term rate, as I said, is somewhat influenced by the Fed, but is heavily influenced by what's happening to foreign money coming into the United States. And in the other term, of course, is inflationary expectations, which we'll get into. So this is a chart that posed problems for Alan Greenspan, who was chairperson of the Federal Reserve. He started in August of 1987 and didn't retire until January of 2006. And so he was grappling with this conundrum of basically short-term and long-term interest rates being very closely tied together. And a lot of it had to do with what was going on in the real economy and what was happening in the international economy. But as you see, after 9/11, in 2001, that's when the Fed aggressively lowered short-term interest rates and went from basically 6.5%, almost down to 1.5%, because they realized that 9/11 was going to be a major shock to demand and to supply to a certain degree, and cause a collapse in confidence. And they were correct that the economy began to falter, and so they eased up on the credit supply, and that drove down short-term interest rates. And you can see that long-term rates changed a little bit, but what it did, of course, is it widened the differential between the long-term rate and the short-term rate. So for a brief period of time, that helped banks, especially the big American banks, the top 10 New York banks, West Coast banks, Chicago banks that had difficulties in this earlier environment, and they were taking lots of risks. And this gave them some breathing room. And so this is a very critical chart for understanding the complexity of monetary policy. And monetary policy is controlled by the Federal Reserve in the United States. It's also controlled now, at the end of this period, by the European Central Bank, because this is when the euro is created, 1999 to 2001. It's a trial period. And we have the ECB, and then we have the Bank of Japan. And in the background, the People's Bank of China is coming into the fore. That this is a new country that's growing very, very rapidly, sometimes as much as 12% a year, but averaging about 10% a year, which means every 7 years the economy doubles in size. And so that transformation began way back in 1978, plutzed around about till 1994. Then from 1994 to 2001, it exploded. And so China is now a big player that has to be taken into consideration when we look at what's going on in this economy. And of course, what the Chinese wanted is they wanted their currency to be undervalued. And the way they did that, of course, is they intervened in the exchange rate market. And the way you keep your exchange rate down is to buy the currency of your competitor, or the major currency being the dollar. So they bought the dollar and drove up the value of the dollar, and in a sense kept the value of the Chinese yuan, or the RMB, down. And they intervened in the money market continuously, and they used the dollars that they purchased to buy long-term U.S. government bonds. And they began to build up a kind of a treasure chest of reserves of U.S. 10-year bonds that would eventually reach $3 trillion. This was not an insignificant event. This was the beginning of a major transformation for the world economy. So I'll end that right now. I'm throwing a lot of ideas out at you. We'll try to tie them together as we move along. But very critical information on slide 5.